I've got a credit union in the Southeast that has an average loan yield that's 9%. 9% is their average loan yield. Guess what? You can have a misery index of 2 if you have a 9% loan yield.
It works. In this next segment, Don and I discuss the benefits for both your members and your institution when you decide to lend deeper. Lending deeper, and in the context of paper and things of that nature, one of the things just in a casual anecdotal observation, I was looking at an $11 billion institution, and I was looking at Callahan's peer ratings, and I was looking at their growth rate, and their growth rate higher than peer in the top 25 percentile. Their earnings are in the top 10 percentile, but when you look at asset quality, it's showing that they're in the bottom 25th percentile. So earnings is high, growth is high. But then what's interesting, when you go deeper into the asset quality, it's not charge-offs that is making them skew lower. It's just past dues. So what it's communicating to me is that by lending deeper, and this is like a $11-12 billion institution, they've been able to grow. They're getting the margins they need to cover their losses and augment capital in a way to provide cushion for the charge-offs that they have. And it's working. And they rolled that model from 1 billion to 12 billion. And I'm seeing that similar dynamic in other credit unions. So they're not scared off by the past dues. And they also are supplemented by a very strong collections and loss mitigation program.
Yeah, 100%. So one of the things I think our practice is known for is helping credit unions lend in all tiers. And to your point, we have a saying in lending that there's a difference between slow pay and no pay. Right. And when we speak to why should a credit union lend deeper, there's a lot of reasons a credit union should lend deeper and lend in all tiers. I'll rattle off a couple for you. One would be if they're a community charter, they made a promise to that community that they would lend to those members, and all their members don't look like the board of directors' credit. Right. Credit unions have oftentimes relied on paper jerks like me. Right. And chasing a combined loss ratio of less than 1%, right? Misery index of 1% or less. Right. Everybody doesn't look like me. Everybody doesn't look like the board of directors. Everybody doesn't look like senior management. And what I would say is, as part of our mission as a credit union, is that we are there to serve, especially if you're a community credit union, right? You said, you made a promise, we're going to take on the risk of the community. I think we need to live into that. That's the promise we made to the community. Again, it's in our DNA, right, as credit unions, that we kind of came out of SEG, employer-based groups, right, where everybody had jobs and, they worked at the factory or they worked at this fire department or wherever. And that's kind of ingrained. But when we all decided to go community, when many credit unions went into the community for good reasons, they took on the risk of the community. They need to do that. Chasing yield is another good reason. It doesn't look like senior management. And what I would say is, as part of our mission as a credit union, is that we are there to serve, especially if you're a community credit union, right? You said, you made a promise, we're going to take on the risk of the community. I think we need to live into that. That's the promise we made to the community. I would bet that they are pretty strong, that credit union, without knowing, just based on those numbers, because I look at the same numbers you do, that they're not asset quality in mortgages where that is happening. That's asset quality in consumer loans. Correct. Right? That's asset qualities. I've got a credit union in the Southeast that has an average loan yield that's 9%. 9% is their average loan yield. Guess what? You can have a misery index of 2 if you have a 9% loan yield.
It works.
You absolutely can. Right. Now, it works. I mean, it's math. Right. But you have to have the strong collections. So chasing yield and mission are the two reasons I believe that credit unions should lend in all tiers. The other thing is that we are a viable alternative, right? 20% of auto loans last year went out at rates greater than 15%. 15%, Anson. And last time I looked, we're in the business of helping our members' financial lives. It's part of the reason that we have a nonprofit status. right?
Mm-hmm.
And we don't pay taxes because we're supposed to help these people.
Mm-hmm.
And if we can offer them an 11.5 or 12% loan for the car that takes them to work every day, that's the business that we're in. It is a much better alternative than them in a buy here, pay here, or a
Right.
payday lender, or going to Santander, right? Going to a subprime auto lender. That's what we're here to do. That's what we're here to do. And we need to be aggressive but smart.